A short disclaimer before jumping into the podcast. The views and opinions expressed by the interview guest in this podcast are solely their own and do not in any way represent the views, opinions, or position of any organization with which the guest is or has been affiliated. All statements made by the guest reflect their personal standpoints only. Hi, welcome and curiosity to a new episode of Governance Unplugged, Internal Audit, Risk and Controls. I'm Thomas, your host, bringing you more than 25 years of experience in senior positions in internal audit and risk management at the Big Fours, and most recently as the head of internal audit, risk management and process improvement at the World Economic Forum. In today's episode, we are stepping into one of the most disruptive debate and misunderstood industry of all times, crypto and Web3. The title of today's episode is From Trustless Code to Trusted Governance, Why Crypto Needs Boards and Internal Audit. At its core, crypto is built on an idea of trustless system. Don't trust people, trust the code. But we have seen time and again the code alone isn't enough. The collapse of FTX, the implosion of Terra Luna, and other spectacular failures have shown what happens when governance is missing or ignored. Lack of controls, mismanagement, and massive losses. At the same time, the sector has produced entirely new models of governance like DOA, which stands for Decentralized Autonomous Organizations, where governance is literally encoded. And now with traditional finance increasingly adopting blockchain and the political landscape shifting, including a pro-crypto agenda in the US, the stakes are higher than ever. Circle, Bullish, Mesh, and other moving towards IPOs, while banks are rushing to play a part. So today we will explore, number one, how governance in crypto evolved since Bitcoin's birth in 2008. Number two, why trustless doesn't mean riskless and what that means for boards. And last but not least, what role internal audit can and should play in building credibility and resilience in this still young industry. To help us deep dive into all this, I'm joined again by a truly experienced guest, Flament, who is a two-time CEO, a builder and inventor in tomorrow's tech infrastructure, and currently a non-executive director at IG Group, a FTSE 250 company. With deep roots in AI, blockchain, digital banking, and tech for good, Mariek brings a rare experience at the intersection of innovation, governance, and impact. She lived through crypto hype cycles, its crashes, and its reinventions, and she knows where governance makes or breaks credibility. Mariek, so great to have you here again, and welcome back to Governance Unplugged.
Hi, Tom. Really good to be here and super happy to be back on a topic that I think your intro was incredible because it is indeed a topic that's very often misunderstood, but actually it's getting more and more mainstream. So really important to understand how governance works in crypto and what does it mean for our future. So super happy to be here.
Let's start with some context, Mariek. Since Bitcoin's white paper in 2008, the crypto industry has promised decentralization, permissionless innovation, and a trustless world. But alongside the innovation, we have seen spectacular failures, as mentioned before, with FTX, Terra Luna, you name it. In your view, Mariek, what has shaped the industry's governance journey so far, and how did we go from idealistic beginnings to headlines filled with scandals and collapses?
Yeah, and I think actually you're right. It's good to start with some context, right? So 2008, you have the Bitcoin paper that actually starts, and it's in the backdrop of a loss of trust against institution and against anything that is centralized. Bitcoin at its core and heart is to enable peer-to-peer without having the need to have a central, entity in the middle. So that's the birth of the movement, which, as we think of governance, is a very big shift because this is about, you don't need to have a small group governing something. It can basically self-govern itself. So that's one. The next big breakthrough is actually Ethereum. And we are now more in 2014. And the best way to think about Ethereum is imagine a very big, autonomous, decentralized, open computer. So it means that anyone, anywhere in the world can code on it and can participate on it. And so what that means is that literally it's enabling to create new movements or new ways of voting or new ways of actually participating. And you mentioned, for example, in your introduction, DAO, decentralized autonomous organization, they were born thanks to Ethereum, because now you can organize people in small community and they can actually have a vote with their tokens and say what they want to participate and what. So the industry, has been basically born on the fact that it's against institutions, against centralization. There's now a way to code trust, and there's a way for anyone anywhere in the world to participate into some of governance. And yet it's very, as you mentioned also in your intro, it's very innovative. So there's a lot of like trial and error. And for example, when we talk about Terra Luna, what happened with Terra Luna was a lot of actually trial and error and very big error. But a lot of that was encoded in code to say, can we create a stable coin that will be algorithmic? So will basically replenish itself. And turns out it didn't work out. It completely blew up, right? So that's when, experiments go very, very wrong. FTX is a very different problem of governance, but it is a problem fundamentally of governance, which I think is actually very, very interesting, in particular in the context of our podcast. The fact is that FTX had very poor governance. FTX was first and foremost a very centralized company. It was an exchange and it had a bunch of other things, but it had no board. It had no oversight. And actually, most people believe that if it had good board and good oversight, it wouldn't have gone into the mess that it did, right? So we have two different examples. But the point is, this industry is based on not trusting institutions and not trusting centralization. It's an industry that is trying to reinvent different models with something that is more decentralized where more people can participate, but it's still new. So innovation goes wrong and it can actually go spectacularly wrong. And sometimes innovation doesn't need to reinvent itself. And actually, if you were plugging a very good old-fashioned governance system on a centralized company, it would probably work.
This is so interesting, and thank you so much for giving us all this context. So governance, if I get this right, governance wasn't an afterthought. It was just the missing ingredient, the one piece that was actually missing. It seems that trustless tech still requires trusted structures around it.
Yes, and actually governance, was far from an afterthought. It was thought of like, how do we do it differently? And with also this idealism of, surely it's better if anyone anywhere can vote on systems. And then actually I'm sure we'll talk more about that, but then you realize that even if you code something, there's always humans behind it. So the way it's coded has bias. And therefore there's always like human involvement into making that work, right?
The crypto mantra has often been, don't trust the people, trust the code. But as we are seeing, the code isn't flawless and humans are still in the loop. So designing, developing and exploiting it. Marek, what are the dangers of over-believing in the trustless system? Why is the mindset incomplete when it comes to building resilient organizations?
Yeah, I mean, look, and I think that's something I've been talking about a lot. Code comes from somewhere. It is actually, and okay, today there's more and more AI that is self-coding. However, even behind that, there are humans who've put their biases in a system, and there are humans who've thought about a system a certain way. And therefore, this idea that you can trust 100% code, one, you don't know if you've thought about all the different possibilities of what could go wrong. And two, there's always, this human factor that is in the background of anything that has been actually coded and encoded. Now, today, it's actually interesting because a lot of people are saying, well, AI can self-code itself, and therefore you're going to have even more of that as created. But I think it's still the same thing. There is human biases that are encoded into how AI is actually seeing or developing things. And so you still have that. So point is, yes, code can enable you to do things in a more, programmatic way, which is like, if this, then that, and if this, then that. But what is encoded in it still has all the thinking and the biases and the thought process of humans. And therefore, not all, not all aspects have been thought through, or actually certain aspects have been over-indexed in a way that shouldn't be.
Exactly. So trustless doesn't mean riskless. And the paradox is, the more decentralized the system, the more important it becomes to define accountability and oversight, isn't it?
Yes, it's exactly that. And actually, I love that. The fact that, trustless doesn't mean riskless. I think that's brilliant because it's exactly that. And then accountability, but also the system and how things and how decisions are being made becomes even more important.
So on the flip side, crypto hasn't only failed. It also reinvented governance itself. We talked about the DAOs, the decentralized autonomous organizations, are one example where governance is literally coded. From your experience, Mariek, what have we learned from these experiments? What's promising and where are the cracks showing?
Yeah, and I think, DAO, so decentralized autonomous organizations are such a fascinating world. There is quite a couple of things that have been learned through going through the experiment. One is that even if it's supposed to be autonomous, it is never fully autonomous. You still have people in the background. And actually, when you want, a vote to happen, you need people to vote. You need people to read documents and to say, do you agree or disagree, right? So there's still work that is involved. And so decentralized autonomous organizations are as successful as the engagement of the people who are in it. Now, guess what? One of the other things that was very much realized in a decentralized autonomous organization is that you find again some sort of layers of people who are involved in it, and you find again people who are very actively involved and making sure that proposals come through and that actually the process is going through. And that is kind of attuned to a company. So in a way, what decentralized autonomous organizations have done is recode what we do as human when we self-organize. And when we self-organize, you can put us in any context, shape, or form. There's going to be a small group that makes decisions and actually that might actually open up those decisions for more voting, but you see almost always the same pattern. So DAOs have been able to code that, to make that more transparent, to basically be able to play with that. There was 2 weeks ago a very interesting example, something that is actually very big in the crypto ecosystem might have, and I think it actually made some headlines even in non-crypto world. It's around a decentralized exchange called Hyperliquid. And that exchange is absolutely humongous. And that exchange basically said, well, we are about to release the ability for someone to own a ticker for a stablecoin. So it's a bit technical, but the idea was you can put your RHP and then people will vote. And guess what? Turns out that there was massive involvement. And guess what? Turns out that people are questioning, was it really the intention to do this or not? So you still find a lot of the same politics that we would see in our normal world. But now all of that is actually encoded on chain. And one of the beauties is that you can actually, see the results and you have better traceability and transparency on it. But the thing is also the dynamics of this voting mechanism are still very attuned to what we're used in our world. So I would say in short, it's been 10 plus years of experiment on those DAOs. They're getting better. We're getting to understand better what it means. But at the end of the day, it's a bit the same point I was trying to make with, trust the code. At the end of the day, there's still humans behind it. And even if you replace humans with, AI agents that are going to vote for us, there's still humans who are going to say what we need, right? So it is, I think it's very important to acknowledge that those are just better tech that enables us to do things that we've been doing for hundreds of years, but in a way that is similar, but probably faster and more transparent.
So DAO showed us the art of the possible, but also the importance of guardrails. Even in code, governance isn't set and forged.
Yeah, correct. It's exactly that.
Today we see traditional finance increasingly adopting blockchain. Banks are entering the space, Circle and Bullish are eyeing IPOs, and the political winds, especially in the US, are turning pro-crypto. Mariek, what does this convergence mean for governance? How can old world institutions learn from Web3, and what would Web3 be learning from them?
Yeah, and I think there's actually a lot of cross learnings here that can happen. I would probably start by and foreseeing that from the boardroom, what does it mean as the two worlds converge? Well, it means there is more and more M&A activity that's happening, and actually it means, for example, at the board level, you need to be able to understand and assess the risk of the assets that you're probably eyeing to buy. And that means that you're now putting yourself in the turf of, okay, what is actually, what is crypto? How does it work? What is custody? Where are the assets? What is the flow? What is the business model? How do all those things work? What assets are actually risky? How do I filter through all of that? And so I think there's a very big muscle to, learn and basically get aware of and to bring into the boardroom at the exec level and so on and so forth. Now, the beauty is, and that's really what can be learned from that world, in particular in the financial industry, There are tools, one of the things in finance that we look a lot at is like KYC and AML. How do you know your customer and how can you comply with anti-money laundering? Where is the money coming from? And one of the beauty of crypto is that you have way more traceability and transparency than you have in actually a pure cash world. And there are tools in crypto such as elliptic and chain analysis that enable you to superpower your audit, your risk department, your finance team in a way that is like, enabling you to do things and analysis that you wouldn't be able to do in the traditional world. So that's something that, can definitely be learned from the traditional world into that, and then a muscle that needs to actually be added to that world. Now, on the flip of it is, what can crypto learn from the traditional world? And, you talked about FTX in our first question. And I think what actually crypto can learn is what is good governance. And when I look at, a company like Circle that has recently IPO'd, Circle has been on a very long journey of having a very strong board for like decades, and of actually thinking, how can you already be a very grown-up company, knowing that maybe one day you'll get to IPO? But that's not something you do from one day to the other. Having good governance, having a strong board, having great oversight, thinking through how do you actually audit? How do you actually do that? So, what sometimes, crypto needs to learn, in particular smaller project, is that there is a huge added value in having very strong governance. There is a huge added value in having the right board. And it's a bit the theme of the first podcast you and I discussed, but very good governance can actually enable you to grow faster and to become better. It's not there to hinder. And the same goes in crypto. So most, Web3 project can actually learn a lot from that, can actually learn a lot from what went wrong when governance in, TradFi or in the traditional world goes wrong. So I think it's really both, right? If you are today, in more the old world, it's how do you beef up your muscle? How do you beef up your governance, your board, and the tools that you need? And if you're in the other world, like, what can you take and learn from good governance? What does that look like?
I see what you mean. As technical as it all sounds, at the end of the day, it really comes back to people, to common sense, good governance, and having meaningful processes and controls in place. So the future isn't about crypto versus traditional finance. It's about the merger of both systems. And in that space, the real winner will be those who can master governance on both ends of the equation. Would you agree with that?
Yeah, it's exactly that. And it's also what you say, like having the right risk and control framework. Like it is good common sense, but just you need to add a new technology in it and understand it deep enough to be able to do that.
This podcast is about internal audit, risk and control. So let's go there for a moment. In an industry that prides itself on being trustless, where does internal audit fit in? What role can it play in building credibility?
It's huge, actually. So I'll give you a couple of examples. For example, today, let's say you're a stablecoin issuer. So Circle is a stablecoin issuer. And what it means is that Circle will say, we have issued that many billions of stablecoins, but someone needs to actually audit that. Have they? Do they have the balance that actually is in front of that? Can we prove that they have enough dollar that it's really one-to-one? Because that's the concept of a stable coin, is that I'm going to put on crypto, on the blockchain, $1, but then I'm putting in a bank account, like the equivalent dollar. So in that world, audit, external and internal audit plays a huge role, which is actually back to if you're, in particular, an IPO company. Can you prove that you have what you say? Can you actually prove that everything is in order and that there is no, money that is missing? In the industry, for example, we see all the big four and more auditors that are also coming because, again, to prove that, very often in crypto, it's a lot about like, is the money where it should be? And is there exactly what is said? And what have been the flows of that? And so I think, when I think of that, I think there is definitely more demand from the big fours and more to actually step into that. There's also a need and an increasing need for internal audit teams to also like be able to prepare that work and to be able also to get the companies to become stronger. For example, if you are custodying assets, it means that you have, somewhere storage of those assets. And so how, the internal audit function becomes, okay, how do you make sure that those assets are where they are? And do we have actually all the controls and all the processes and everything that works in case something goes wrong and so on and so forth? So, those functions are just very important, becoming even more important. And as the two worlds, as we mentioned, blend each other, I think we're going to see more and more of those roles emerging as a need to actually provide, the reassurance that is needed. Now, the good news is part of it, thanks to the blockchain technology itself, should be more traceable and transparent, and therefore actually, in a way, easier to provide, reassurance and confidence on. But the reality is that transactions still remain private. So you still need that internal audit function and external audit function to actually assert what is really being there and how things happen.
Yes, internal auditors can't write the code, but they can assess whether the right checks, balances, and processes are in place. It's about giving stakeholders, from investors to regulators to the users, the confidence that the risks are seen and properly managed.
Exactly, 100%. It's the same. It's still the same job. You'd be delighted to hear that. It's still the same job.
Crypto is volatile by nature, and crises are part of its DNA. When the next big crash or regulatory shock comes, what should boards in this space do? How should they show up when things are going sideways?
So, yeah, unfortunately, yes, it's an industry that's seen a lot of, highs and lows. Very often the lows are because governance failed. And, you mentioned Terra Luna, you mentioned FTX, but very often when something goes wrong is because there was something wrong in the system. Like it was, either purely because you have people who wanted it to go wrong and therefore put money in its fraud, or because things were not thought through in case, an event happened. I think the best way to prevent that is, again, a very traditional old-fashioned way, but is to think through your risk and controls. For example, let's say you're a company and you now have a significant amount of crypto. What happens if you get hacked? And so therefore, what are the steps? What happens if one of your third parties goes under? And therefore, what are the steps? What happens so it's still the same mechanism. And I think the more you can be prepared to that, to, do scenarios, and the more you can think through it, then the better your controls are going to be and the better you can address a crisis. And then, crisis management, good crisis management is always the same. It's like thinking through, okay, now that things have happened, like what do we do and how do we learn from that? But I think it's always the same thing, that the best prevention is actually the mechanism of thinking it through. And I think that's also where, both internal audit, but also like risk committees and audit committees and all that governance can actually help think it through and say, okay, when things will happen, and because we live in a world where cyber attacks are becoming more common, we live in a world where, things are even more volatile. We live in a world where crypto is actually very embedded into traditional finance. If you look at, stablecoin issuers are now the 7th largest holder of US Treasury. Well, one of the things to question is what happens when that goes wrong, right? So I think it's just the same mechanism, looking at your business and therefore assessing where the risk could be and do you have the right controls in place, or do you need to do something else to prevent things to go really wrong?
Exactly. Trust can't be built in the middle of the storm. It has to be there long before, and that's really where governance proves its worth. Over the past years, I have seen internal auditors evolving significantly. They are no longer just coming in at the end to review what happened and issue findings about the past. More and more, they are being invited to the table to listen, to think from a risk perspective, and to engage in open, constructive dialogue with management and the business. It's about anticipating what could go wrong in our projects and plans and making sure those risks are addressed through the right controls and measures. Isn't it, Mariek?
Yeah, it's exactly that. And sometimes it's very helpful to have actually internal audit and teams who think that way, because, crypto is in a world where you need keys and you need access and you need people. And so thinking through all the things that could go wrong is very helpful to actually have that mindset to help the teams like ramp up, beef up, and therefore have the right framework in place.
Founders' board dynamics are complex in any sector, but in crypto, they can be particularly challenging. So how do you, Mariek, build trust here? What's needed for founders and boards to have a constructive, high-performing relationship?
I think it's the same as it is almost in any startup. It starts also with what's the construct of your business and therefore what are your needs? And in crypto in particular, there's so many different shapes and forms of organization. You have, for example, crypto foundations who are very, very large holders of treasury. And therefore, the role of the board and the role of the governance is the governance that you need for any foundation. It's like, is the foundation doing what it should be doing? Is the money being spent in the way that it should be spent? Are we actually abiding to all the laws and that are in place? And are we making sure that, the team is actually doing its job? So that's where it is actually very, very important to have that mechanism. For startups that are in this space, very often what I find, what can be challenging is that, again, because of a part of the mindset that comes from crypto, which is this idea of decentralized and don't trust actually institutions and don't trust centralization, sometimes it is actually, there's almost like a disregard for why would you need governance? Why would you need a board? But the way to think about it, and what I say very often is like, think of it as the 6 men or women on the team. It's like, it's really the thing that can superpower you because it's someone who is not in your day to day. And it's someone and a group of people who are not in your day to day, who add skills, who usually have external experience and expertise and that they've seen different things. So the tensions are similar to what we see in the startup world with this additional complexity that a lot of the mindset is against anything that is, too institutional or actually too centralized. But I always think, there's always a very good middle ground for making things actually work together. And again, very good boards will be a superpower and very bad boards will actually completely tank your project. But thinking of your current context and what's needed for you, super important.
Thank you, Marieke. That's fantastic. And it ties back to what I mentioned earlier. Governance isn't just about controls. Governance deserves a seat at the table. It's about co-creation. The same applies to internal audit. It shouldn't be something that happens at the end of the process. It should be part of shaping it from the very start. Founders who see their boards as partners, not as brake pedal, are the ones who truly unlock real, sustainable growth.
Completely, 100%.
Imagine a founder sitting across from you, building their first crypto project. What is the one piece of governance wisdom you want them to carry with them from day one?
I think the best piece of governance advice is actually think about what can go wrong. And when you're an entrepreneur, very often you're solving problems every day. Like every day, it's like, solving. But I think good governance starts by projecting yourself a bit more long-term on what are the things that could go wrong, things that you might not be able to control, things that might be a bit more in your realm of control, and things that you can really are completely under your control. That's advice number 1. And advice number 2 is actually think about governance of your project and what does a good board for you and the stage you're at look like. And it might be that you're in a different context or you actually are at the place where it looks more like an advisory board than it is like a very formal board. But as we discussed that in our first podcast, but the earlier you think about it, the more you build that muscle, the more you also can leverage it and the more you learn for it. And as you grow and scale, then actually you have the right setup.
Marieke, thank you so much. This conversation has been fantastic and really gave us an insight in crypto's governance paradox. It's trustless tech, but the need for trusted boards and meaningful assurance is absolutely there. You have reminded us that governance isn't the enemy of innovation, it's a multiplier. Whether we are talking about Bitcoins, legacy, DAO, TradeFi, convergence, or the role of internal audit, the message is clear. Without governance, credibility just collapses. With that, the industry can truly scale. Before I let you go, Marieke, I would like to ask you 2 final questions. If you could tap every crypto board member on their shoulders and give them one piece of advice, what would that be?
I think it would depend, but I'm going to imagine I'm tapping on the shoulder of someone who comes more from a traditional background and is now helping a crypto project. What I would say is that when you step into crypto and blockchain, it is still an area that is gray. Things are not fully defined in law. But that's where actually good common sense prevails. And rather than, trying to prevent, things because they're not defined, you can actually use all the good common sense and all the things that you've seen across the board and in your career and apply that to make sure that the project you're helping and looking after is successful.
And the very last question, Marieke, if our listeners would like to learn more about you, where can they go?
So for folks who stayed that long, the best way to learn more is actually to look me up on LinkedIn.
Great. And we're definitely going to do a link in the show notes so that everyone can find you very easily. And to our listeners, thank you for tuning in once again. If today's conversation resonated with you, please subscribe to the podcast and rate it on your favorite platform. Follow us on LinkedIn or visit us on www.keystone-governance.ch. And as always, let's build smarter, more resilient organizations, one conversation at a time.